All right, let's just jump right in, because today we are tackling a huge question, one that's really at the heart of our entire economy. How do banks actually create money? It's a process that's surrounded by myths, but I promise, by the end of this, you are going to see the system for what it really is.
So let me ask you something. When you think of a bank, what's the first image that pops in your head? Is it a giant steel vault, kind of like a massive warehouse where everyone's cash is just stacked up, safe and sound? It's what most of us picture. But what if I told you that's not even close to the real story?
Because here's the thing, and this is the crucial point. The whole idea of a bank as just a simple money warehouse, well, it's a myth. The reality is something way more powerful and frankly, kind of mind-blowing. Banks are actually money creators. They don't just shuffle money around. They literally bring new money into existence.
So first things first, let's really unpack this warehouse story. I mean, it sounds logical, right? It's what most of us were taught. But it completely misses the most important part of how modern banking actually works.
You know the old story. It goes something like this. You deposit $1,000, the bank takes your money, sticks it in the vault, and then lends, 900 of your dollars to someone else who needs a loan while keeping a little bit back in reserve. It makes perfect sense, but it's just not what happens.
And to understand why, we have to talk about something called bank reserves. Now listen up, because this is key. Reserves are not your deposits. They are a totally separate, special kind of digital money that only commercial banks and the central bank get to use. And what do they use it for? Settling payments between themselves. So when you pay your friend who uses a different bank, your bank zaps some of its reserves over to their bank. It's like their own internal payment system.
Okay, so let's get to the real process. This is the part that sounds a little bit like magic, but I swear, it's the foundation of our entire economy. Money isn't printed in a basement somewhere. It's born from a simple keystroke the second a loan gets approved.
So here's how it actually goes down. When a bank gives you a loan, it doesn't reach into a vault and pull out someone else's savings. Nope, it just goes into your account and types in the loan amount. Poof, a new deposit appears. And that new deposit is the loan. It's brand new money, created out of thin air in that exact moment.
And this super simple balance sheet shows it perfectly. Let's say our bank here, Wee Bank, has $10,000 in total deposits and $1,000 in reserves. Now they approve a new $1,000 loan. Suddenly, total deposits jump to $11,000. But look at what didn't change. The bank reserves are still exactly $1,000. The new money was created as a deposit, totally separate from the reserves.
Now, I know what you might be thinking. You're probably remembering something called the reserve requirement, and you're not wrong. In the past, banks did have to hold a certain chunk of their deposits as reserves, usually about 10%, and that rule definitely put the brakes on how much they could lend.
But here's the kicker. Today, in the United States and a lot of other major economies, that reserve requirement is set to 0%. That's right, a big, fat zero. This is exactly what people mean when they say banks can literally create money from nothing.
So, wait a minute. Does a 0% reserve requirement mean banks have found some kind of unlimited money glitch? Can they just create loans forever and ever? Well, not so fast. In the real world, there are still some very real limits that keep the whole system from spinning out of control.
See, the problem for the bank is that people don't just get a loan and let the money sit there. Of course not. They do what we all do with money. They spend it. They might pull it out as physical cash from an ATM, or more likely, they'll transfer it to someone else to buy a car or a house, often sending it to an account at a totally different bank.
And this creates the first major constraint, withdrawals. While the bank can create digital money with a few taps on a keyboard, it can't create $100 bills. It has to have enough real cash in its vaults to cover everyone who wants to make a withdrawal. If it runs out of physical cash, it's in a world of trouble.
The second big constraint is transfers. Remember those bank reserves we talked about? Well, when a borrower sends their new loan money to someone at another bank, the first bank has to send an equal amount of its own reserves over to that second bank to settle up. And that drains their reserves, which puts a real limit on how much money they can afford to see flying out the door.
So as you can imagine, this whole system of creating money through lending has massive implications for the entire economy. There's a really powerful upside, but also a really dangerous downside. On the one hand, this ability to create credit is basically the fuel for modern economic growth. It lets businesses expand and people buy homes without having to wait for a giant pile of savings to be ready first. But the risk? If banks lend way too much, way too fast, they can flood the economy with money, creating dangerous bubbles and a whole lot of financial instability.
And the ultimate risk, the absolute nightmare scenario, is a bank run. This is what happens when people lose faith and they all rush to the bank to pull their money out at the same time. Since the bank only holds a tiny fraction of its deposits as actual cash and reserves, it's physically impossible to pay everyone. The bank collapses, and that panic can set off a chain reaction that brings down the entire system.
So, if that 0% reserve requirement isn't the main thing holding banks back anymore, what is? Well, let's look at the two modern regulations that really keep banks in check today. The first real limit is called bank capital. Now, this is the bank's own money, the money from its owners and shareholders. Think of it like a safety cushion or a shock absorber. When some loans inevitably go bad and the bank loses money, it has to use its own capital to cover those losses. If the losses are too big and it runs out of capital, it fails.
And the second limit is liquidity. This is all about cash flow. A bank has to have enough liquid assets, cash and reserves, to handle all the day-to-day demands of withdrawals and transfers. A bank could be profitable on paper, but if it runs out of liquidity and can't make its payments on time, it can collapse overnight.
Okay, so let's boil this all down. What are the key things you absolutely have to remember? First, banks create brand new money every time they issue a loan. They don't just lend out savers' deposits. Second, that old reserve requirement you learned about, it's 0% now in the US. And finally, the things that really limit banks today are capital and liquidity.
Which leaves us with one last big question. Now that you know the secret of how money is really created, what do you think? Is this system a brilliant engine for growth and prosperity, or is it a dangerously fragile house of cards just waiting to collapse? It's definitely something to think about. Thanks for watching.